So hello and welcome to Conversations with Esther, this 18th October 2023. Today we speak to the financial doctor who is in the house, Bwana Alfred Mathu. It's an honor to have you here. As is our culture, I will pray and then we can kick off. Let us pray. Heavenly Father, we thank you this evening for your goodness and faithfulness. Thank you for bringing us together to learn. And thank you for everyone that will listen to this now and in the future. We pray that this message will transform them and transform their lifestyles and their way of thinking. We thank you in Jesus' name. Amen. So, karibuni sana. Welcome, Eric, Damaris, Neni, Rose, Peter, Beatrice, Joe, Steve, and Eric Muthomi. I will go straight into introducing our conversations with Esther before I can actually go to the guests. So here we go. So conversations with Esther, kindly mute once you join in. Conversations with Esther is an impact-driven media platform that informs, educates, and rebuilds mindsets to ignite ethical practices within organizations and the community. Conversations with Esther provides a professional, safe space speaking to matters affecting the workplace, social circles, and the overall mental wellness. Now, guided by our three values, integrity, excellence, and impact, Conversations with Esther envisions a world transformed by candid conversations, respectable relationships, and the goodwill to make every effort count. Now, you can subscribe to our YouTube, Conversations with Esther Katiba. Follow me on LinkedIn, Esther Katiba, and also on Instagram as Conversations with Esther. Now, to join our online community, I will give you 1 minute. Maybe you can just pick your phone and scan that QR code. Now, that is our community where we update you on the next session, any other events. So kindly pick your phone and scan that in a minute or so. I will allow that so that you can join our community. We are building a network so that we are able to also update you, share with you every session that we have. Any events that are upcoming, we are able to update you. Yes, so I think that's good enough. Let me get a thumbs up from somebody that has done it already so that I know before I can move that we are together. I'm waiting for a thumbs up there on the emojis so that I know we are good. Good, thank you. Thank you. So now today we have the financial planning, investment, and retirement session. And I have a few quotes here that caught my attention as I was preparing. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. I will not attempt to explain that because we have the doctor in the house. The next one says, money is only a tool. It will take you wherever you wish, but it will not replace you as the driver. And the final one says, and I really want the financial doctor to speak to this one. This one just caught my attention. A bank is a place where they lend you an umbrella in fair weather and ask for it back when it begins to rain. I don't know. I will leave it to the expert, Bwana Mathu, so that he's able to speak to us on that one. Now, those are our social media pages. I'll still go back here. I want to introduce our guest this evening. We have an expert in this field, and I love his his title, the financial doctor. Now, Alfred Mathu is a leading financial advisor, a household name in the Kenyan insurance industry. Emanating from his long service and professional experience, Mathu has become an icon in the corporate business leadership. Alfred has over the years ascended to senior leadership positions and currently leads in the advisory role. He is the founder and CEO of HISA Africa Insurance Agency Limited, and I want to appreciate them here because they were one of our key partners in the event. Asante sana HISA for stepping in to transform lives. Now, HISA Africa is a reputed intermediary for two customer-centric financial giants, Old Mutual Group and the Absa Life Assurance Limited. HISA Africa offers financial advice on retirement planning, contractual investments, emergency funds, and medical insurance. He will tell us more about this. Following his year-on-year performance record, the insurance industry in Kenya through the Association of Kenya Insurance, AKI, has over the years named Alfred Mathu as the leading financial advisor, mentor, and trainer. Now, I went down to his profile and Bwana Alfred, congratulations, 26 years of experience. That is longer than some of the people on the call have lived. 4,700 portfolio clients, approximately 684 policies matured. That tells you how much you can trust him because he has seen all this come to fruition. Now, 59 plus death claims and awards are all shining here. I looked at the awards. Bwana Mathu, congratulations. Head of Retail Affluent, Old Mutual Africa, Old Mutual Africa Agent of the Year Award, Old Mutual Africa Top Unit Trust Award, Old Mutual Africa Top Achiever Awards, and much more. So karibu sana Bwana Mathu. The floor is yours. I am your student as well. Karibu.
Thank you very, very much, Esther, for having me on this floor this evening. Good evening, everyone. I'm extremely delighted to be in your midst this evening to briefly talk about financial planning and how we can use the knowledge that we are going to share this evening to be able to improve on our day-to-day planning aspects as well as the spending aspects and be able to build reserves that will be able to take care of our tomorrow. Before you can start this presentation, I just need to give a brief of the background from which a lot of us are coming from in this country of Kenya. So that approximately 97% of people spend more than they earn. About 95% of retirees are asset rich but cash poor. That Kenya has got some of the poorest retirees in Africa. About 94% of retirees depend on fundraising to meet their medical obligations. Majority of those that have managed to get pension after retirement deplete it way when they are healthy, and from that point onwards, they start depending on others. Less than 1% of Kenyans have got succession plans. Many retirees are unable to dispose their solid assets to be able to raise cash to meet their recurrent expenses. That our country has got a very high population of financially disciplined people who work for now and spend everything. Many spendthrifts have got no strategy on how to educate their children in the university and high school. A lot of people have sunk into debt due to lifestyle expenses, while others are having huge medical bills that have literally wiped their savings. Based on the money personalities in Kenya, we got spenders, we got dreamers, we got savers, and a very, very small fraction of investors. You'll be telling us more where you belong. Many retirees have resorted to alcoholism and depression after being abandoned by their children. Sometimes our attitude may reflect our plans to unplan our future plans. Let me repeat that point. Sometimes our attitude, and the word there is attitude, may reflect our plans to unplan our future plans. But with proper financial planning and education, all these narratives can be changed. Once again, my name is Alfred Matthew, and I'm a financial doctor. I speak to people on financial matters or about financial matters just to help them in the planning and execution to be financially independent at old age. As Esther has taken you through my profile with 26 years of experience and serving two customer-centric giants, the Absa Life Assurance Company and the Old Mutual Life Assurance Company. We've got all that you need in terms of your short-term, your medium-term, and your long-term investment solutions. I'll be taking you through just a few slides just to be able to put you in the proper perspective and be able to understand exactly what I do. So what is financial planning? If we start from there. Let me tell you what. Financial planning is the ability to align your finances in order to meet your short-term, your medium-term, and your long-term goals. Every person has got what they call their short-term goals, and this is basically what we call emergency needs. We got what we call the medium-term needs. These are majorly the contractual needs that come along the way, either educating our children, buying or building a house, purchasing a car, taking your family on holiday, etc. And this would always run to a time frame of between 5 years to about 10 years. We got also what we call the long-term plans. Here we basically talk about retirement and succession planning. And as I said, the bigger population of the Kenyan investors don't even have any solid succession plans in place. And a lot of them are working towards the retirement empty-handed. That you started working when you were 24 years, 26 years, 30 years, and every day you wake up, you've forgotten that you're working towards your retirement. A lot of people get to retirement age when they are empty-handed. They actually literally get caught off guard. You never saw it coming, but you've been on this journey for 20 years, 30 years, some even for 40 years, but never prepared. Just some of the statistics that I also wanted us to go through here, that about 91% of Kenyans spend more than they earn. 70% do not have income at retirement. About 98% of those retired people rely on medical fundraising to offset bills. What you know about retirees is that they've got all the time. What they lack is the money. The youthful investors, on the other hand, have got all the time until they run out of it. There are many good goals, and especially the financial ones that we keep postponing. This is what we call the procrastination. A lot of people, as they celebrate the new year, we come up with what we call New Year resolutions. But soon after the new year starts, we forget the new goals and go back to the old lifestyle. Where are you? 47%, retirement was to happen at the age of 60. 47% of the retirees in the Kenyan market, based on statistics that have been proven, will be depending on relatives. That you are here, yes, but at the point you hit the retirement age, let's work with 60 years for this matter, that 47% of retirees will be depending on relatives. That 1% will be forced to continue working even after the first retire. 60% will have income, but very low income replacement ratio. Only 6% of, Jacinta, if you could kindly mute, 6% of the people will be financially dependent. The people here that are not worried about their obligations of today or tomorrow. All they have to worry about is updating their succession plans. I will be taking you through this roadmap that is very, very important. This is going to inform the person that you are ultimately going to become. It is important to understand your money personality. And as I said earlier, you can only belong to any of these 4 categories. You are either a spender, you could be a dreamer, you could be a saver, or an investor. So who is a spender? Of course, you know these guys. People who especially spend on very flash lifestyles. You want to drive the best car on the road, even when you cannot afford it. These are guys that from time to time are swiping credit cards. They live above their means. The guy will be in the most expensive apartment for show off. The guy will be on social clubs every Friday, Saturday, and Sunday, drinking and splashing money all over the table to show people that he's doing well. We talk about that much later. We got the dreamers, the guys that keep talking about the big things I want to achieve in life. That at retirement, I want to be driving a Range Rover. I want to be driving a Porsche. I'll be living in Lunda. I'll be living in Kilimani. My house will have to have a heated swimming pool. They talk about the big things. The only thing they lack is the drive to get started in terms of savings. Because there are people who are called the savers. These are people who understand the need to put aside, but they're not very deliberate about the return they get or the money that they have put aside. These are people who majorly leave their money in the bank account. That, yes, I'm earning 200,000 shillings, I spend 150, so I religiously leave 50,000 shillings in the bank account. But a year down the line, you've lost so much against inflation. So that is the saver. And finally, you've got the investor. I'll be talking about that much later. It is good to be able to make timely, and the word is timely here, timely money management decisions. You may have the best decision, but at what point do you execute it? You may want to come up with the best agenda that I want to start investing for retirement, but you're starting it at the age of 67 with plans to retire at 70. I want to make the best of my retirement now that I'm working. That you start off something at the age of 58 and you're retiring at 60. So when you execute your investment decision or your money management decision is very, very important. The other one is to be able to diversify the scope of investment. Don't put all your eggs in one basket. I come across lots of investors that have primarily invested in one asset instrument, say RAD, that when you get money, the only thing you do is to buy RAD. Every time you get money, the only thing you think is to buy RAD. The question you ask yourself is, how about at a time when an emergency comes up and you're not able to dispose that piece of RAD? How about when you've invested in a piece of RAD that is worth 100 million, but at that particular time you only needed 2 million? Do you go taking a loan of 2 million against a piece of RAD that is worth 100 million? At point 4, it is good to be able to manage your wants and liabilities. For a lot of people who have been key investors, the only reason that they have failed is because of having unmeasured wants. You want everything. In life, you either be spending on a want or a need. But the shocking thing is that for us, needs are those basic things that you cannot be able to do without. For a lot of people, even some of the wants have become the needs. You interchange them. Let me go to the last one, 5th one. It's important for you to be able to secure your accumulated wealth and be able to come up with a legally acceptable mechanism of distribution. Yes, you've amassed all this wealth, whether you've invested in the bond market, whether you invested in the stock market, whether you've got an investment in a bank, fixed deposit for that matter, whether you've got a money market account, whether you've got a construction investment program, whether you've got a pension scheme. The question is, do you have a mechanism by which your next of kin can be able to access this wealth if you're not there? A lot of assets that Kenyans have accumulated have ended up in the unclaimed assets organization. Only because there's no mechanism of distribution, whatever that you left behind, no one is claiming it, so it ends up with the government. What is the need of making such a huge sacrifice and not be able to take care of the people that it was meant to take care of? I'll be talking about that much later. But let me go to the 3 very, very key pillars of financial planning. The first and the most important pillar is what's called the accumulation. Accumulation is what most of us are doing, either you are contractually or non-contractually building a portfolio. Whether you're doing this from your salary, whether you're doing this through a business, whatever investment that you are doing that is giving you income, which you accumulate over a period of time to be able to achieve a bigger agenda. This is what makes a very, very important pillar that we call the accumulation. You accumulate over the period. But unfortunately, what Kenyans don't realize is that your productive years are not forever, not going to be there forever. There's some certain stages of your life that you're going to be very, very productive economically. But soon when you retire, you go now majorly into spending. If you have not accumulated enough, you hardly be able to achieve any significant milestone on your income replacement ratio. The second pillar is what we call the growth and conservation. That yes, whatever that you've accumulated, it is able to grow over the years, and it is protected. You do not want a scenario where you put together, but you put in an environment where your assets are not appreciating over time, and that if a small calamity comes your way, all that you have put together will be depleted. For example, you're trying to build a business, and so much has gone in as the input towards building that business. But along the way, before the business has come to fruition, you get sick. You're diagnosed with a terminal illness, cancer comes in. Now, you start selling off whatever that you had started building, you start selling it off so that you can pay the bills in the hospital. I want to tell you what, we are in a society that has actually not taken sufficient precaution to protect our assets. Lots of people end up giving their title deeds of either houses or properties to lenders who can give them some bit of funding to be able to meet medical obligations. That only because you are admitted in hospital for 1 week and your bill short, the only option you have is to mortgage your house. Only because you are admitted in hospital and your bill hit 700, the only option you have is to take a loan against your car. Only because your child has been admitted in hospital and was admitted, discharged when the bill was at 1.5, you are now taking a Shylock loan. And you are giving all your assets to the lender to be able to procure that facility. That is poor planning. I will talk about the third one, which is the distribution. And it is only in Kenya where people don't die. Let me tell you what, Kenyans don't die. They only rest in peace. We are too soft on issues of death. People do not face death as a real reality. It's a reality. What would happen if? Of course, when you got employed, those that are formerly employed, your employer must have asked you to provide details of your next of kin or your beneficiary for that matter. Why? Because they know this life is not permanent. So what is this that makes people to later on think that life is so permanent that you no longer see the need to keep your house in order in terms of succession? A lot of people don't have wills. You do not even have a person that you could trust with your succession matters. So in the event of your demise, people have to fight their way. And a lot of times, the main people that were supposed to benefit are actually the ones that are thrown out of the list. All the thugs will show up on that day. It is important that you can visit your legal expert to be able to guide you on matters of succession. We not want, let me tell you what, I'm always shocked here that the burial of a man can be stopped anytime. The burial of a man can be stopped I've not heard of a lady's burial that was stopped, but burial of men can be stopped in a time. You only know that there was burial to happen when it has actually happened. Because there's so many things that happen before that last send-off, right? Some people have been omitted, some people appear there with children, some people appear there with 3 children, and you hear there's a family that was not even known, there's a family that was never introduced, and this will always be very, very dramatic at that point of send-off. These are things that are very, very familiar to all of us. We are aware of death. The unfortunate thing with death is that it gives no one notice. No one knows the day, the year, the month, even the time, or what is going to be the cause. But the reality is, there are some guys who are not going to see December with their eyes, and today they are healthy. The reality is, there are guys who will not see this weekend because they'll be in mortuary. It can be me, it can be you. The reality is, there are people who are making all plans even for international travel with their family over Christmas, but they're not going to get there. These are the realities of life. And because you never know about the date, you never know which month, why can't you plan that if anything ever happened to me, I will not want my people to go through the suffering to access whatever that I would have left behind. Make it easier. Disability. How about if you become disabled? How does that affect your financial productivity? Will you still be able to do the same work that you're doing today? If you lost your sight, you became blind, you got to ask yourself today, in your organization, do you have people that are working who are already disabled or they have lost their sight? So if you became bright or you became disabled, it then means that you'll also be shown the door. How have you planned that if such things happened, that will be well cushioned? Disability will not happen because you are careless. You could also be on the road, you're the best driver, driving the best car. But how about the other driver? Maybe the other driver is careless. They subject you to some of these things. It is good to be able to have provision that in the event anything ever happened to me and I became disabled, I'll not have to be raising money for upkeep through fundraising. That you've got a disability benefit that will immediately come in place and take care of you. How about critical illness? This is an area that has always overwhelmed the doctors. So many people are working to hospitals, looking very healthy, and soon after some medical checkup, you hear the worst. That the guy has been diagnosed with cancer of the cervix. The guy has been diagnosed with prostate cancer. The guy has got a heart problem. The guy's kidneys are operating at 40%. These are terminal illness diagnoses. It can happen to you, it can happen to me. But if it happened, how cogent are you? Who will be able to handle your financial obligations? Do you know when you are diagnosed with a terminal illness, your focus changes towards the medical bills and not working? Last one is the last expense. In a country that believes in fundraising in everything, even for last send off the person that was doing so well, you can only send off the person through a fundraising. How about if you decided to purchase a very simple product or plan called last expense cover, which even with about 6,000 shillings would cover you and your nuclear family to a tune of 500,000, that you're only paying every year, 6,000 shillings every year for a nuclear family, maybe husband, wife, and 3 children. You're only paying 6,000. Can you imagine how cheap? 6,000 shillings to give security for up to 500,000 shillings in case of death of any of the members, whether the husband, the wife, or any of the kids. Instead of waiting to do a fundraising, why not purchase a last expense cover that will be able to give your family a bit of comfort? That if anything happens, you only invite people to come and help you in burying, not enlisting funds for the coffin, not enlisting money for that people will eat. I want to use a few animals to be able to share a couple of money management lessons. The first one is the animal that we call the lion, very, very fearless animal, which takes control of its environment. What you know about lions is that when it comes to eating, they don't play games. They eat to their fill. You as an investor want to encourage you to invest as much as you can because you're never sure of your next circumstance. The reason why lions eat to their fill is because they're not sure about their next meal. They eat and ensure they eat enough. They don't play games. When lions are eating, they don't play games. You as an investor, when you're investing, we also don't want you to play games. Invest as though you're investing the last year. Have as much money in your reserves as possible. Because in case there was a disruption, like we had one 3 years ago, the COVID disruption. So many people depleted their savings within 1 month. So many people depleted their savings within 3 months. But you know what? Those that had built sufficient cushion went through the second year without much of worry, because they knew for sure what they had in their reserve was good enough. Second animal is what we call the elephant. And before I got to the animal elephant, I drew your attention to a gentleman called Warren Buffett. According to Warren Buffett, we should be spending the balance of our investment. That when you make your money, invest first, spend the balance. It's the surest way for you to take charge of your money. When you make money, invest first, spend the balance. But to the ordinary men and women, when we make money, we normally spend first. Whatever that remains is what you're going to invest. And we hardly have surplus. That's why a lot of people are waiting for the day that they'll have surplus for them to start investing. I want to tell you what, you've got to make that bold move. That for me, when I make money, 22.5% of my income will have to go into investment. I will always spend on the balance. Second animal is the buffalo. The elephant. Elephant has got an amazing memory. You as an investor want to have an amazing memory. You know the things you want to achieve this year, or you wanted to achieve this year. You also have an idea of the things you want to achieve next year. And because Kenyans are very forgetful, we encourage you to write down the things that you want to achieve. Write them down. Even go to the next level, whatever that you've written down, put them in a conspicuous corner of your bedroom, so that anytime you wake up, anytime you come to the bedroom, you are reminded of the things that you wanted to achieve. Write down, put that in a conspicuous corner of your bedroom, so that you're always reminded that I want to take up a plan for my retirement. I want to take up a plan for my firstborn daughter towards investing for education, university education. I want to take up a mortgage. Whatever it is that is financial, write it down, put it where you can be seeing it every day so that you're well reminded. You know, a lot of Kenyan people have got very poor memory. In fact, I'm also told that Kenyans don't have memory at all. So many things that we desire to do, and we are doing nothing about them. Or we only talk about them today, and tomorrow we are doing the opposite. Let's talk about that animal. That animal is called the rhino. The rhino charges towards all the threats that come its way. The bigger the threat, the higher the level of charging. You as an investor, you need to charge towards all the threats that come your way. One of the threats that you could possibly see on your way is overspending. The other one could be spending without a budget. The other one could be peer pressure, that you wanted to take an investment, but your friends discouraged you. You wanted to open a money market account, but your friends said there are other better options other than money market. You need to charge towards all those threats. There are people who have a lot of fear. They fear that I might lose. That's the reason I'm not starting. So all these threats that are on your path, deal with them. Procrastination could be another one. That is postponing of financial goals. I want to go to the next animal. This is the leopard. This is a very focused animal. The moment it identifies the prey, it will make every careful move towards that prey. And the next minute, you know, it has brought down the prey, and that is not enough. It will move with that prey to the highest point of the tree, where it knows that its meal is safe. There are many things that are avoiding you or keeping you away from achieving your goals. And a key one here is procrastination, and I talked about it. It's got the final one is a buffalo. It's a very, very interesting animal, which knows too well that there's only one survival mechanism, staying with the rest of the herd. The moment a buffalo isolates itself from the rest, it immediately becomes a target by the carnivores. So what are we talking about here? We talk about diversification. When it comes to investments, diversify the scope of investment. Don't put all your money in RAD. Don't put all your money in a fixed deposit. Don't put all your money in a child's education policy. Don't put all your money in stocks. Diversify the scope. Realize that you got short-term needs, you got medium-term needs, and you got long-term needs. I talked about the money personality, and this is very, very interesting. And I know at this point, you already feel where you belong. I talked about this person that called the dreamer, who only keeps talking about the big things, but is never taking the first step. For you to achieve that big dream of buying a big car, of owning a house in Lunda, of owning a good business, a profit-making business, that conversation starts with saving money towards that decision or towards that plan. Have you taken the first step? That you'll be telling us that, you know what, the reason I'm putting 50,000 shillings aside is because one day I want to buy a house, and this house will have to be in Lunda. That the reason you're putting 100,000 shillings aside is because in the next 10 years, I want to have built sufficient savings for my retirement. Let me tell you what, guys, if I've had an encouraging encounter, it was early this year. A young girl introduced to me by the mother, and who happens to be in the second year university somewhere in Australia, told me that, you know what, Mr. Matthew, I was given your contact by my mom, and I wanted to just discuss with you a bit on investments. I wanted to hear more about money markets and about what I could also be doing, to start building my savings. Then I asked her, what is your agenda? Why do you want to build savings? The girl gave me a story that surprised me. She told me that, I'm born in a family of two, myself and my younger brother. And when I was in form 3, my father kicked my mom out of our matrimonial home. And from that day onwards, she suffered so much to be able to bring me up and my brother. Now, when I went to Australia and I started my degree, I've been given a job by the university, a job that I do 3 days in a week. The other 3 days I'm in classes, but 3 days within the week, I don't go to class. There's some work I do for the university, and these guys are paying me. So what I want, I'm in a position where I can put 150,000 shillings, and my agenda is one. I want in the next 8 years that I buy a house for my mother, and I'm looking at buying this house for my mother somewhere in Lavington. Look at that. That I want to start putting 150,000 shillings the next 8 years because I've got intentions to buy a house for my mother, who is currently paying rent because our father kicked us out of the matrimonial home. So this is no longer a dream now. Because the person has moved to the next step of, I want to start that account that can help me save 150,000. And that is exactly what she did. At an age of 22, can you imagine putting aside 150,000 with a clear goal that 8 years from now, I want to buy a house for my mom somewhere in Lavington. So what goals do you have? And have you taken the first step? The second one is the spender. The spender, I talked about these guys that spend on lifestyle expenses. They are all of us splashing their cards. They will live in the most expensive apartment. They will drive the most expensive car. They even have jewelry all over. This guy will have the most expensive mobile. This guy will have the most expensive clothes. And not because he could afford, but for show off. The other one is a saver. I talked about the guys that always leave money in the bank account. They're not doing so much with that money, but they religiously put it in a bank account that, yes, I earned 200, I spent 150, so 50,000, I keep it in my savings account in the bank. If you ask that guy in the last 5 years, how much return did you make in that savings account in the bank? They hadn't made any return. But for them, the fact that they're putting aside, they think that is all that they need to. Talk about the investor. Investor is this guy that works with an accountability partner, that you sat with somebody of sober mind and agreed that these are the things that I want to achieve the next 2 years, or the next 1 year, the next 5 years. That accountability partner. And you've shared your roadmap. I want to be saving this much every month for me to be able to realize this goal. Or I want to take up a mortgage next year. I'm currently saving this much so that by the time I'm taking up the mortgage, I would have raised 30% or 40% or 50%. Or I'm working very hard to put money aside because I want to take my children to this kind of a university. I want to take my children to this kind of a school. You are working with an accountability partner because the moment you try to digress, your accountability partner will always come back and ask you, by the way, you told me that you are taking your kids to St. Andrews School next year. How are you faring? So if you're about to lose it, you get back on track. This guy is one who understands their risk appetite. They know which environment will be higher risk investment. They also understand which environment will not be able to give them the best value for their money. These are people who have very long-term plans. They're not just talking about today. This is somebody who has an idea of what they want in the next 10 years, the investor. The big question that for us today is, are we clear of the goals we need to achieve the next 10 years? Are we clear of the goals we want to achieve the next 5 years? Are we clear of the things that we want to achieve next year? Or are we part of the bigger population who keep saying that I want to achieve the following, but soon after that, they forget? I'll go quickly to the next slide. And here I'll be talking about what is eating my money. Imagine having 100,000 shillings kept under the mattress in an environment that is experiencing 10% inflation. You'd be too shocked to hear that 20 years down the line, the purchasing power of your money would have been eroded from 100,000 to 14,864. That would be the value of the money that you're holding today. In 20 years, if the same is not going to be put in an investment that appreciates over time. If you subject your money to an environment that you're losing against inflation, be sure that the first year, your 100,000 shillings will have dropped in value to 90,000. On second year, it will have dropped to 82. And this will progressively happen up to an amount of 14,864 by the 20th year. So what can you do here? Put in your money in an environment where it appreciates at a rate higher than the inflation. In the financial basket, we got many solutions for you. For the emergency fund, we got a solution for that. For the medical, we got a solution for that. Accident, disability, we got a solution for that. We got life insurance, in case of death, that your people are going to be taken care of. I talked about last expense. I've talked about critical illness. Those of us that have children or have plans to have children, you've got to start investing for them. Then we talked about the medium-term investment, which takes us to contractual investment. And then finally, I talked about the retirement investment. I want us to look at this. The money that you need may be categorized into three. Money that you may need now is what you call the emergency money. And that would have to come from an emergency account. The saddest thing is that a lot of people don't have anything in the emergency fund. If you got sick, you start selling off your assets to pay the bills. Naturally speaking, an emergency fund should have a minimum of 3 to 6 times of your monthly living expenses. Let's say, for example, every month you need 100,000 shillings for your current expenses or for your monthly expenses. In your emergency account, you need to have a minimum of 3, which will be 300, maximum of 6, which is 600. So have between 300 to 600,000 shillings lying in your money market account or your emergency account. This is money that you can be able to access overnight. You can be able to access it as and when the emergency comes up. You don't have to borrow money from friends. You will draw the money from your emergency account. And as soon as you deal with the emergency, you build back the emergency to the threshold that I've talked about. How about the aspired money? The next 10 years, the next 7 years, the next 8 years, you perhaps want to build a house, you want to buy a plot, maybe you want to develop that plot that you already bought, maybe you want to upgrade your car, maybe you want to take your children to good university, maybe you're taking your children to good high schools. This is what we call the aspired money. And for the aspired money, you need a contractual investment solution to be able to achieve such an agenda. This is an agenda that runs anything between 5-10 years. And then how about the future money? What happens when you retire? The economic productivity will reduce, and your greatest concerns will be around health and your retirement expenses. So for that environment, we're able to offer you a very ideal solution for retirement investment. You also ensure that you've got a sensible, sizable medical insurance. And of course, now in that space, you also be dealing with succession issues. So what is the money market? If I will tell you very, very, very briefly, what is the money market? Money market is a short-term investment instrument where money is placed in the government securities. You know of treasury bills, you know of treasury bonds, debentures, commercial papers, etc. If you talk about, for example, the old mutual money markets, which we got this in both the Kenya shilling denomination and we also have the dollar. What happens in this particular fund is that it has got minimal risk. Minimal risk. Our guiding principle for this particular fund is placing high priority on security of your money. Interest is calculated on a daily basis, and it is added to the lump sum every end of the month. The current standing in terms of return is 12.25%. The 11.3 was a bit historical a couple of months ago. Right now, it's 12.25%. So for the money market, which is an ideal emergency fund account, whenever an emergency comes up, you just write an email. And the funds will move from your money market account back to your either bank account or your M-Pesa account. And it will be able to help you address that emergency. I even give an example of somebody who decides to build a fund starting off with 50,000 and every month doing 50,000 shillings top up. At that particular time, the interest was 11.08. Right now, as I said, it's 12.25. Within 1 year, this guy would have built 637,000 shillings against an injection of 600. And don't forget, this money you can withdraw anytime. There are no conditions, there are no restrictions. Even if you invested for 1 month and wanted to call your money, you get that 1 month savings, but as the interest for 1 month. If you invested over a period of 6 months, you're able to get the savings of 6 months and interest of 6 months. So instead of letting your money lie in a bank account where it actually depresses over time because of charges, why not put it in the money market? And whenever you need it, just do an email. The money reverts back to your bank account. My key area of passion is retirement planning. Ladies and gentlemen, if there has ever been an area that draws concerns, especially for the retiring people or retired community, is this area of retirement plan. How many people that we know that used to do good jobs, they are high ranked in the society, but soon after retirement, the worst has since happened. That you drove the best car. Right now, as a retiree, you are a pedestrian. You used to go on holiday twice in a year. Now the farthest you can go is Uhuru Park. You used to buy clothes from the most expensive shops. Right now, you are getting accustomed to second-hand clothes in Gikomba. These are the things that we witness every day. And the question that everyone asks is, what happened? It's about retirement plan. It is important for everyone to be able to establish their current monthly expenses. Just have an idea of how much do I need on a monthly basis for me to be able to meet my monthly obligations. Let's say it's 100,000. You must be able to build a fund which can generate 100,000 shillings or a minimum of 85% of the 100,000 by the time you're retiring. Let me take you guys back a bit. Let's take hypothetically a scenario of somebody like myself. Let's say that I'm 50 years now, and I want to retire at the age of 60. So I've got 10 years left. Call it 120 months. My current status is that I'm earning an income of 200,000. Again, hypothetical. You're earning 200,000 shillings per month. The 200,000 shillings per month will translate to 2.4 million shillings every year. Assuming that status quo remained. By the time you're retiring, you need to have built a fund, liquid fund for that matter, not plots, not land, not businesses. You need to have built a liquid fund which can generate a minimum of 85% of 2.4 million. That today I'm 50, I want to retire at 60, so I've got 10 years left, which is 120 months. My current salary is 200,000. Now, 200,000 shillings every month will translate to 2.4 million shillings every year. I got 10 years left to build a retirement fund. And this retirement fund, by the point I hit the retirement age of 60, that retirement fund, which I'm calling F, invested conservatively at just the normal market rate of about 12%, 10%, 11%. Let's work with 10%, which is very conservative return. That the fund F multiplied by 10%, 10 out of 100, should be able to give us 85% of 2.4 million. That is not what you call retirement plan. Now, let me tell you where the Kenyans are. You are at the age of 50, you are retiring at 60, you are earning 200,000, but all of it is being spent. Either dealing with your wants, dealing with your needs, paying school fees, paying mortgage, paying for a car. By the time you are getting to retirement and near to retirement, that is now when the reality dawns on you that, by the way, I'm retiring next year. When I look at my pension, that pension, when I get it, the maximum it will be able to give me is 30,000 shillings per month. Now, if you used to earn 200, but now you have to lower your lifestyle to fit to an income of 30,000. You used to be on 200, now you are settling on 30,000. My brother and sister, that is when your nightmares will start. That big car that you're driving, you'll have to leave it at the parking. That lifestyle of living the suburbs in Karen, Riverside, Runda, and wherever, you have to be humbled to Kitengela. You got to start again in Kitengela. And I'm not saying Kitengela is bad, but for somebody who was living in Runda, having to be humbled to a level of Kitengela, you can imagine what that means. You drove a Prado, you drove a V8, you drove a Range Rover, but now you become a pedestrian. You know what that means. You used to go on holidays twice, one local holiday, one international holiday. Now you cannot afford anything that can take you beyond Uhuru Park. You know what that means. That everyone is abandoning you, including your children, because you are a liability. When they see you, they know you'll be borrowing. That is the exact status of retired people who never planned. And the question is, do you want to be part of the statistics? Do you already have clarity of the things that you need at the time of retirement? Who will be meeting your bills? Don't forget that by the time you hit retirement age, that medical cover that you're enjoying from your employer today will no longer be there. You'll have to be paying the bills from your wallet. Thank God if you retire while having a medical insurance. But also don't forget, a lot of the insurance companies will not be able to give you insurance when you are old. They want to insure you when you are young. So what will happen now when you cannot be insured, when you are uninsurable? It means that your bills will have to be from the pocket. If you have not saved enough, who will be paying that bill? It is your children. The moment they pay the first bill, you make them pay the third bill, you make them pay the fourth bill, they'll block that number. You'll be calling them, they'll not be picking up your calls. You'll be calling them, they'll not be anywhere to come for a rescue. So why not take personal responsibility? You got all the time left. It was the other day I was 30 years and I was laughing at my father who was then at 60. Today I'm 52. It was the other day I cleared campus. Now the retirement is staring at me. Every person feels young until they run out of time. And the most unfortunate thing is that only 2% of Kenyans that listen to financial planning conversations actually take action. The rest will call me a preacher. The rest will say he was just talking. Only 2% will out of this say, hey, hold on. I cannot afford to continue living the same lifestyle without taking action. My retirement is coming. I'm 40 years, I'm retiring the next 20. I'm 50 years, I'm retiring the next 10. I'm 45 years, I'm retiring the next 15. I'm 52 years, I'm retiring the next 8. You take action. Establish your current monthly expenses. Consider the amount of time left that I'm 50, I'm retiring at 60, so 10 years left. I'm 40, I'm retiring at 60, 20 years left. Then establish an instrument that help you generate the required retirement income. Do I put this my savings in a contractual investment? Do I go into a pension scheme? Do I go into a money market? Where do I put my funds so that at the point of retirement, that particular instrument will then be able to generate the monthly income that I need. Then, of course, go to establish and implement your retirement plan. I've given a perfect example here. Perfect example. Ladies and gentlemen, the analysis of products in this country, with my 26 years of experience, the most superior medium long-term contractual investment has been provided by one customer-centric giant, the Absa Life Assurance Company. This is the product. Anyone that is looking at building funds to educate their children the next 5 years, the next 10 years, anyone that is looking forward to build funds that will help you buy a house, anyone that is looking forward to accumulate funds that will help you develop that plot, anyone that is looking forward to build savings that will ultimately take care of your retirement, this is the solution. The ultimate solution is the contractual savings. I'll tell you what, the most superior that we've got right now is in the umbrella of Absa Life. I've given a very clear example here. A plan running for 10 years, where somebody decides that I want to start with a monthly savings of 75,000, and I'll subject my investment to a 10% increase every year. So if you look at column number 1, 2, 3, 4, 5, column number 5, monthly total premium. The guy started off at 75,399. He increased that at the second year to 82,934. On that year, increased this to 91,221. On the fourth year, increased this to 100,338. By the 10th year, the person is saving 177,698. Overall, in 10 years, this guy has put together 14,387,940. And this, you can see it under the column of accumulated premium main benefit. You see there 14,387,000. Now, let me tell you the juicy part of it. That in the next 10 years, as you're doing this investment, Absa has taken care of a number of uncertainties that may come your way. One of them would be death. How about if you died in an accident? If this guy in the first year died in an accident, Absa will pay 10 million shillings against a total savings of only 902,000. 902,784. If this guy died in an accident on the second year, the benefit will be double. That's now where you see the immediate accidental death benefit will be at 21,400,000 against a savings of 1,895,844. If the guy died in an accident on the third year, the payout will be 22,898,000 against your own injection of 2,988,204. Let's look at what happens by the 10th year. By the 10th year, when you're still on cover in case of accidental death, the total that would be paid in case you died in an accident would be that 6,769,184 against your own input of 14,387,000 shillings. That's by the 10th year. So at any one stage, if you accidentally died, we got your children and your wife covered. We got your children and your spouse covered. That's in case of accidental death. Let's look at the next one, disability. How about if you become accidentally disabled before the 10th year? As long as the account has started and you have paid your premiums up to that particular point, in the event of accidental disability the first year, we'll pay off 10 million shillings. Absa will pay off 10 million shillings, and all the future premiums of that policy will be waived. You will not pay any more money. You wait until the maturity of the policy to be paid off your benefits. If it happens in the second year, Absa will pay 10,700,000. Again, the future premiums will be waived of that policy up to the maturity. When I say waived is that you've paid 1 year, for example, then you became disabled on the 10th month. The 10 million shillings has been paid, and all the premiums that you have paid on the second year, third year, fourth year, all the way as per your contract, you will not pay any more money. The future premiums are going to be waived. Absa will take over all your premiums up to the maturity and will be entitled to your benefit. Now, let me look at the one in red. The one in red is talking about natural death. Don't forget I talked about the accidental death. Now, this one is natural death. Natural death is like, for example, perhaps heart attack. Heart attack is not an accident. That is classified under natural death. So if it happened the first year, the benefit is not much because you're in the waiting period or the free cover limit. The payable benefit is 902,784. It's like a refund of your premium. But let's look at it on the second year. If you suffer natural death on the second year, you have a benefit of 10,700,000 that will be paid against your injection of 1.8. And by the 10th year, the benefit that will be payable at the natural death will be 18,384,592 against your own injection of 14. So at any one stage, you got your accidental death covered, disability is covered, natural death is covered. Let's go to the next element, is critical illness. The second last, at the critical illness, that in the event of critical illness diagnosis, on the first year, there's no benefit because you are in the waiting period. The first 12 months, we want to ensure that people do not misuse this product. That when you're already sick, that's when you come to take up the plan. No. We want to ensure that the first 12 months, you are in the waiting period. But on the 13th month, you unlock the full benefit. So in case you are diagnosed with a terminal illness, say this is like cancer heart problem, and the report has come from your doctor, and ABSA has been able to verify that it is true, a benefit of 5 million shillings is going to be paid, and all the future premiums of that policy are going to be waived. You're not going to pay any more money, and you'll be entitled to the full benefit at the end. There's one benefit I don't want to forget called medical hospitalization. On this particular one, if you got involved in an accident and were admitted in hospital for more than 3 days, then you'll unlock this benefit. And this benefit is normally 0.2% of your insured amount, sum insured amount. Let's say, for example, it happened the first year. The sum assured the first year is 10 million. So 0.2% of 10 million will be like 20,000. You'll be entitled a benefit of 20,000 shillings per day up to maximum of 30 days. But remember, to unlock it, you must be admitted as a result of an accident for more than 3 days in hospital. So if you got into an accident and are admitted for 2 days, you don't unlock anything there. If you're admitted in hospital for 1 day, you don't unlock anything there. But admitted in hospital after an accident and you're admitted for 3 days upwards, the benefit payable will be 20,000 shillings per day, and then the benefits remain intact. Ladies and gentlemen, let me tell you what. After enjoying all these benefits, can you imagine on the 10th year, you got 21,223,051 shillings non-taxed payable benefit to you. And you can see that amount down there. And this is a guaranteed amount. Let me tell you what, the reason why I say that this is the one of the most superior products in Kenya is that apart from giving you guarantee for benefit in the event of accidental death, disability, critical illness, medical hospitalization, it also gives you a guarantee on the amount you're going to be paid at the end of the term. You go to a 21,223,051, and it is in your contract. Once you sign up, and this is what you've taken, that amount is in your contract. You only have to ensure that you maintain your obligation of paying every month. This amount that you're going to be paid is not going to be taxed. But from that, you qualify for the normal government tax relief of up to 50% of the premiums, but maximum 5,000 per month, or 60,000 shillings per year. I mean, this is a product that all of us need. You don't have to do 75,000 shillings. You can always start where you think you can afford. Whether it's 10,000, whether it's 15,000, whether it's 30,000, whether it's 150,000, whether it is 200,000 shillings. The thing is, the numbers here are going to be driven by your disposable income. You can always have a conversation with you as an individual, and I show you exactly what you need to do to be able to know the amount that you need to be saving to be able to meet your agenda. Quickly go to this one before I can come to the end of the slides. That the cost of delay. There are so many investors who choose to procrastinate. And a perfect example has been given here. A young investor at the age of that one decides to put 100,000 shillings every year up to the age of 40. So in 10 years, this guy saved $1 million, but then decides to leave that money in that particular fund, and the same was compounded up to the age of 60. So when the guy came for his money, he had only invested $1 million, but because of the compounding aspect and having started when he was very, very young, he had 11,794,087 shillings. Let's go to the second investor who was slightly late. This guy now starts the investment at 41, but continues investing up to the age of 60. So in those 20 years, he invested 2 million. With a compounding of 2 million shillings in the next 20 years, the guy only had 6.3 million shillings, 6,300,249. Then that investor is the net investor. He decides to start at 51 and did it for 10 years up to the age of 60. So 10-year investment of each 100,000 shillings, he had 1 million shillings saved. But when he came for his money on the 60th birthday, which was 10 years later, he had 1.753 million shillings. So what you can see at a glance is that, can you imagine the last guy, who is the rate investor, invested 1 million, but only went away with 1.7 because he came late. The other person, the first one, invested 1 million, but because he came early, gave the money enough time for investment purposes, he walked away with 11,794,000. And then the almost rate investor came at the age of 40, invested up to 60, and only got 6.3 million shillings. So the question is, When would you like to do investment? Would you like to do it late? Would you like to do it at the right time? Ladies and gentlemen, let me say what? Financial planning is a journey. It's a conversation that all of us need to have. And it's very, very, very personal. What you're doing with your money is different from what the other person is going to be doing with their money. You're going to be held personally accountable for the money that you earned. It is good to be a prudent investor. If you're married, your husband or your wife never receives your salary. You receive your own salary because you need to take personal responsibility. Even if your husband is so close to you, even if your wife is so close to you, even if your boyfriend is so close to you, no one can be paid your salary. When you'll be judged based on the money that you earned. So if you let yourself be guided by others and to be misled, don't forget you only be judged at personal level. It's good to be able to plan wisely. Because they say if you don't plan, you are planning to fail. These are conversations that we would need to have at very, very personal level. You can take my number there, reach out to me. Let's have a date, have a cup of tea, a cup of coffee. I'll help you understand who you are. In the four money personalities I talked about, the spender, the saver, the dreamer. You actually be able to understand what is your money personality. And then I'll be able to give remedy of what do you need to do now to be able to meet the various short-term, medium-term, and long-term investment agenda. We give you a platform which will actually be able to help you achieve that agenda. The more you wait, the more expensive it becomes. You're not going to be young forever. If today you are 30 years, next year, whether you like it or you don't like it, you're going to be 31. If you're 35 years, next year you're going to be 36. If you're 25 years, next year you're going to be 26. You cannot do anything about your age. You are technically going towards your retirement at whatever speed. Those that are in 40, they've got few years left. Those in 30, you also have got not so many years left. Those that are at the starting, make the best use of your money. Put aside as much as you can for you to be able to meet your agenda. Esther, I'm throwing this back to you to open up the floor for any kind of question that our listeners might have before I can close the day.
Wow. Wow. I'm just thinking through. I think everyone has their own message, and I like the way you said it. We attend a lot of this, but actioning that, I don't know. Now, there's one question here, I know in the interest of time. Good evening, Conversations with Esther and the Financial Doctor. Thank you for the awesome training. My question is, there's a policy with KCB called Elimisha Saving, whereby it targets those with CAB or children account. I save for 12 years with a policy of 500,000, saving 6,200 monthly. Upon attaining 12 years, I'll be able to reap 1 million, which I can start making withdrawal from the 8th year. Kindly advise if it's the right option to save for a kid. Since 12 years, he or she will be almost joining high school. So you can respond to that.
First of all, I say a big congratulations to that member because they have already taken a bold step. That is a very caring parent. They knew there is a financial obligation that is coming. The moment a child is born, I mean, right from the time the child is conceived, you know, totally, you are going to have a baby who will need some financial support. Can you start planning? This is a person that I would actually tell congratulations because that's a very, very caring parent. And let me tell you what, for me at times, it doesn't matter whether the product is going to give you very high return or not. The first thing is to get started. The second thing is that we can always sit down and evaluate the benefits that come along with that particular program. We'll look at, is it the best that we could have done? How else can you enhance it? And we will never be able to, we will never cancel that program. Even when I sit with you and you got a plan with the KCB, and we realize that the ABSA one is more superior, I will never encourage you to plan. I will only come up with an idea to enhance. What else can we do to make this more profitable? We will never cancel what you already have, because what has already been started is already started. For me, we'll be looking at what other key areas should be considering at this point How about if I became disabled and I'm having that plan with KCB? How would they cushion me? How about if I was diagnosed with cancer? How would they cover me? How about if I was unable to pay off for this particular? We'll be looking at all those things. And then for me, I run it through to you ideas of this is the way we can be able to enhance. What I would be able to tell you here again is that, of course, the ABSA plan is too superior to compare with what the bank, KCB is offering. This product is too superior. But all said and done, at the end of the day, there's nothing wrong with having two plans towards the same agenda, one enhancing the other, one supporting the other. In other situations, you get somebody who has got an education plan, but realize that the family is more exposed in case this guy became disabled, or this member died, or this member got critical illness. So we enhance by giving perhaps a personal investment plan. So for me, I would really want to sit with this particular person and be able to look at that particular program end to end. We see what are the missing links. Then that is the advice I'll be able to offer. Back to you, Esther.
Wow. I see another one here. There's a lot of good messages, great insights. Thank you, Alfred. Wow, very well put. There's another one, Eric Muthomi. Which firms can you recommend for the money market funds, and what are the minimum savings?
Good stuff. Now, let me say something about money market. Ideally, money market comes under what's called the unit trust. Unit trust means collective investment scheme. And different investors who come into unit trust will have different agenda. Some will have the short-term agenda, others will have the medium-term agenda, others will have the long-term agenda. Money market happens to be that short-term investment instrument within the unit trust that takes care of the emergency, especially, or short-term investments. Of course, there are many players in this industry, and I don't want to name particulars so that this is better than, because all of them are regulated. All of them are regulated by Capital Markets Authority. But what I must tell you is that you got to look at the strength of the money market that you're getting into. Very, very solid institutions are there. We also have got weak ones. We've got some that are very, very new entrants. We've got some that have been in the market for the longest time. I know, for example, Old Mutual, which is one of the top players, has been in. Old Mutual is actually the pioneer of money market, of the unit trust. The Old Mutual unit trust business started in 2003. All the other players we got in the country came after Old Mutual. If you look at the performance of the Old Mutual money market, perhaps if not the best, it's one of the best. I think for me, what I would really want is this person asking this question, can you sit down? Let's look at your situation. What is driving you? What kind of money do you want to invest? What timeline do you want to invest that money? And then at that particular point, I'll be able to recommend. But I said, all money market players are regulated by the Capital Markets Authority. You can never say that some of them are bad or others are good. The difference will only come in the value for your money. Some will have return that is slightly higher than others. But of course, even in the aspect of after-sale service or the customer support services, when you request to redeem your money, some companies will have your money in your bank account within 2 days. The others, which might pay, is in 4 days. So it's always also good to consider the aspect of efficiency. When there is a question, that there's some organizations that are able to get back to you within an hour, others within 2 hours, but there are also others that will come back to you after 2 days. Some of those are the considerations that we're going to make. But all the money market players are good because they are regulated by Capital Markets Authority.
Wow, I think I'll combine these ones in the interest of time. I know we've gone way beyond 17 minutes past 8. I'm 26 years. Can I start saving for retirement or invest? The next one is Peter Nuya. Thanks, Peter, for joining. What facilities can relate to a real business that will be profitable and a better retirement plan? Again, Peter says, great insights, Mr. Alfred. Does it mean investing in interest earning facilities is better than pursuing a business venture?
Let me handle the first question. The 26-year-old who is asking whether it is appropriate to start investing for retirement. The 26 is actually, you're actually late. The first question I'll be asking, how long have you been working? Maybe you'll tell me that you've been working for 1 year or 2 years. You need to start your retirement investment the first day of your employment. Because your journey to retirement starts the day you start earning. That day. Now, of course, People that have worked for 5 years and have not done anything on retirement agenda are way later than the one who is 26 and who might have worked for 2 years. But we also have got guys that are now 45. They are considering retirement investment now. The others who are 50, they are starting now. The others who are 57, they are trying to start now. The trouble with that is that when you start an investment for retirement late, you got a very short period left up to retirement, and therefore you'll be strained to be able to meet the target that you're giving yourself. A person who is 26 years old, who wants to retire at 60, that person has got about 34 years. Assuming the target here is 100 million, and the one who is today 45 and wants to retire at 60 and given the same target of 100 million, what you know is that the young person has got 34 years to build 34 million, and the 45-year-old has 15 years to build the 100 million. So the one who is older has fewer years left. Therefore, you have to put in much, much, much more for you to be able to realize the same target that you talk about. This is the time frame for money. So I will tell you that, yes, the best time to start investing for retirement is on day one. But if you are a year or 2 years or 3 years late, we can always get started at this particular point and move on. But the person who is heading to 60, my brother, you are late. There are people who come my way when they are 60, and the only thing I tell them is that, my brother, you need to start enjoying your retirement. Don't start investing for it. You're already late. Enjoy what you have. And the trouble with most of them that come my way, if there has ever been one concern that I get from retirees, one simple concern of retirees, the bulk of them keep saying that, how I wish I knew. I would have saved a bit more for retirement. Because most of them, as I said earlier, they deplete their retirement savings when they are still in good health. Now, when you deplete your savings, it means that you become somebody else's liability. So why can't you start now so that by the time you're getting to retirement, you got all that you need? You can now be touring this world because you got all the money. You walk to a showroom and buy the best car. Why? You can afford it. You saved enough. You can go for the holiday of your choice. You can visit your grandchildren. You can visit, I mean, there's so much to do when you have the money in this country. So I want to encourage that 26-year-old, get started. Back to yesterday's question, the second question, remind me, kindly.
The other one was what? The other one was for Peter. What facilities can relate to a real business that will be profitable and a better retirement plan? And he also asked, does it mean investing in interest earning facilities is better than pursuing a business venture? And maybe allow me, for in the interest of time, those on the call, maybe we can just do 5 minutes so that we finish. Allow Alfred to respond to the questions, then we close. Thank you.
I didn't get that question quite clearly, but from the little information that I got, let me say what? That all investments are good if they're aligned to your risk appetite. Don't go into an investment instrument whose risk appetite is above or beyond what can accommodate. There are people who trade in shares, and it's a good thing. Where is the market today? The market is down completely. Those guys are not shaken. What they are doing, now that most of the counters are low, are cheap, they are buying more and more. But a person who is trying that avenue and is a short-term investor is counting the losses. If you want to go into multi business, it could be a business that will give you profit. But the thing is, do you have that kind of appetite for that kind of risk? Because a lot of people have tried and they have failed within 1 year, they have gotten depression within second year, and they have died on the third year. So before you can go into any kind of business, try to study your risk appetite. Do not misalign the two. Where you went into a long-term business expecting short-term results, it doesn't happen. It doesn't happen that way. So these are the people that I actually want to have a one-on-one engagement. Well, let's sit down, let's talk, let me hear you, and then I'll be able to guide you appropriately. As I said, my services are for free. Me, I'm paid by ABSA, I am paid by Old Mutual. So when I meet with you, you're not paying anything. Me, I'm a consultant paid by those two organizations, and they're adequately taking care of me. All I'll have to do is to sit down with you. I'll be able to explain what path you need to take with your money for you to be able to realize the set out agenda. Then I will show you where to start. I will show you which platform is the best. I'll look at which one has higher risk, which one has lower risk. And at the end of the day, my agenda is to help you be able to achieve the best way possible with minimal risk. Back to you, Esther.
Wow. Wow, I think I read the last one. Honestly, I don't think we can answer all those things. I keep investing money in treasury bills, but I think I'm not growing it. That's one person. Jacinta Kiprop says, wow, what a great night. Thank you, our trainer Alfred, as well as Esther, for having decided to empower and motivate. How much is your consultation? Jacinta, you've been answered. It's free. Great presentation. Death is a reality that has always stressed people, and yet we fail to transfer this risk to insurance firms at a small premium. That is Wekesa Simon. So maybe the only one you may need to touch is I keep investing money in treasury bills, but I think I'm not growing it. Maybe you can speak to Jacinta's issue.
Let me say this, Esther. Let me use a simple example here of transporting 5 bags of cement, and I want to transport these 5 bags of cement to Nyahururu because I've got a construction ongoing there. I can decide to put those 5 bags into the boot of my car, my small car. I can also decide to use a pickup. I can also decide to hire a van. I can also use a lorry. All of them will take the 5 bags to Nyahururu. But don't you think taking 5 bags of cement to Nyahururu by means of a lorry will be very expensive to me? That is the point. So the question is, that investor who is trying the treasury bills, you need to adequately be empowered in terms of the other available options, which would first of all help you to accumulate your wealth contractually, and then use a lump sum which you can bargain the rate of return. If you walk to a bank with 200,000 shillings, you have absolutely no chance to negotiate return. If somebody walks to that same bank with 10 million shillings, even the bank manager wants to have a sitting with you. If you walk to that bank with 50 million shillings, I'm telling you, even the chairman might even get to know you. If you walk to that bank with 200 million shillings, I am telling you what, the entire board of management of that bank will know you. So the thing is, we perhaps need to use a different avenue to contractually build the lump sum, which will then be able to subject to that treasury bill option, so that you can be able to negotiate your way. But as it is, you perhaps are now using the lorry to transport cement to Nyahururu. Let's get back. You perhaps need to take the smaller van, the smaller car, take your cement, it will be more cost effective. These are the conversations that I really want to have with people. So that person asking that question, we can always have a one-on-one. You've got my number there, you've got my email address there. Drop me a line, and we can be able to have a sitting of a cup of tea. I'll be able to listen to your background, where are you coming from, what are your objectives of the investment, and I'll be able to give you the best tailor-made investment solution that will help you achieve your agenda. Back to you, Esther.
Wow, thank you, Alfred. I think for those on the call, please join our network. We will definitely plan some good physical coffee with you and Alfred. I think we need to plan that, Alfred, so that we're able to talk to people one-on-one in partnership with HISA, so then we can help you transform your lives. Thank you, Alfred. Thank you for your time. Thank you, everyone on the call. Have a great evening. God bless you, and keep it locked here. We meet here next week, same time, 7 p.m. Asante sana.
Thank you so much. Thank you so much, everyone. I'm wishing you well. A lovely night ahead. Let's talk more on money.
Thank you. Bye-bye.